Welcome back to The Explainer, everyone. Today, we're basically putting on our financial detective hats for a really rigorous, strictly numbers-driven investigation into Sensient Technologies, or SXT for short. We're going to sift through their latest performance metrics to try and find the stock's true intrinsic value. As an equity analyst, my goal today is just to cut through all the market noise and look solely at what the hard data tells us. Let's dive right in. All right, here is our roadmap for today. We've got 1. The SXT valuation challenge, 2. Absolute valuation models, 3. Relative valuation multiples, 4. Asset-based valuation, or NAV, and 5. Synthesis and final verdict. Okay, let's start with the big number, $112.93. That is the last closing price of SXT, which gives the company a market cap of roughly $4.8 billion. I really want you to keep this specific number in your head, because every single calculation we perform today is going to be compared directly back to this $112.93 benchmark. We need to know, is the stock severely undervalued, fairly priced, or dangerously overvalued? Well, let's find out.
Section 1. The SXT Valuation Challenge, setting the baseline.
Now, as professional analysts, we always have to state our assumptions absolutely transparently. Because some forward-looking data points aren't explicitly sitting right there in the historical source file, we're defaulting to a standard 8% weighted average cost of capital, or WACC, and a 2 to 3% terminal growth rate for our cash flow models. Plus, for relative valuation, rather than guessing at imperfect competitors, we're going to use SXT's own historical averages as its most accurate peer group. This is going to tell us exactly how the market is pricing the company today versus how it normally prices it.
Section 2. Absolute valuation models. Cash is king. So for our discounted cash flow, or DCF model, we have to look at the trailing 12 months free cash flow, which currently sits at $38.41 million. But what's honestly really concerning here is the trend beneath that number. SXT's 5-year free cash flow compound annual growth rate is actually negative 25.42%. Yeah, negative. It's shrinking. And that leaves SXT with a microscopic free cash flow yield of just 0.80%.
So when you project those shrinking cash flows forward and discount them back to the present value, you get some severe sticker shock. Based on the source data's pre-calculated DCF fair value using free cash flow, the intrinsic value of SXT is just $44.18 per share. Compare that to our $112 benchmark, and wow, we already have a massive gap. And hey, even if we use an earnings per share basis for the DCF, the fair value only bumps up to $53.68, which is still less than half the current trading price.
Let's try another absolute method, just to be sure. The dividend discount model, or DDM. Step 1. ST pays a dividend yield of 1.45%. Step 2. We look at the 5-year dividend CAGR, which is barely moving at just 1%. Step 3. We discount this back using our assumed 8% cost of equity. Look, because the yield is so low and the growth rate is virtually non-existent, the DDM value remains extremely suppressed. It doesn't get us anywhere near $112.
Okay, let's move to a third absolute check, the residual income model, and see if this builds our case at all. This model basically checks if a company generates earnings above its cost of equity. SXT boasts a return on equity of 11.27%, so against our assumed 8% cost of equity, SXT is indeed generating positive residual income. Hey, they are creating value, but unfortunately the spread is only about 3%. It adds a slight premium to the book value, but mathematically it is just not nearly enough to bridge the massive gap to a $112 stock price.
Section 3. Relative valuation multiples. Pricing against history. Let's look at a classic, right? The price-to-earnings ratio. SXT is currently trading at a PE of 35.74. However, its 3-year average PE is 29.70. What does that mean for us? It means buyers today are paying a roughly 20% premium for the exact same dollar of earnings compared to what buyers paid over the last 3 years.
And this premium isn't just isolated to earnings. Current enterprise value to EBITDA is sitting high at 19.29. Historically, over both a 3-year and 5-year average, it hovers right around 16.5. From price to sales all the way to price to free cash flow, practically every single multiple in the source data confirms the exact same story. The market is pricing SCTE significantly higher than historical norms across the board.
Section 4. Asset-based valuation, or NAV, the balance sheet floor. This brings us to a really fun thought experiment. What if we strip away all our assumptions about future growth, margins, and market sentiment? What if we value SXT strictly by the tangible things it owns right now? To do this, we calculate the net asset value, or NAV. We simply take total assets and subtract total liabilities. Based on the metric data we've got, the absolute most direct proxy we have for NAV is the book value. So let's reverse engineer it from the ratios.
Here's how the math shakes out. The data shows SXT has a price-to-book ratio of exactly 4. That means the market is charging $4 for every $1 of actual net assets. If we take our current stock price of $112.93 and divide it by 4, we get an implied book value, our NAV floor, of roughly $28.23 per share. So intrinsically, the hard assets back up about $28 at that $112 price tag. The remaining $84, well, that's just the premium investors are paying for future expectations.
Section 5. Synthesis and final verdict. The big picture.
When we bring all these models together, the overall picture is remarkably consistent. Literally, no matter which angle we approach this from, the intrinsic value calculations lag far behind the trading price. Our free cash flow DCF gives us $44.18. Our earnings DCF gives us $53.68. Our asset-based NAV gives us an absolute floor of $28.23, and our relative multiples tell us the stock is trading at a roughly 20% premium to its own history. Every single fundamental model points to a value significantly lower than $112.93.
Now check out this margin of safety calculated in the source data based on those free cash flows. It is negative 155.62%. As focused learners, you know that Benjamin Graham's classic concept of a margin of safety is all about having room for error. A negative margin of safety of this magnitude means the stock is priced for absolute perfection. If growth stumbles even a little or margins compress, there's absolutely no cushion.
So, looking at this stark contrast in the data, the verdict is honestly pretty clear. While Sensient Technologies might be a wonderful company with positive residual income, the fundamental data we've analyzed today tells us the stock itself is showing strong signs of overvaluation. The market is demanding a massive premium that the underlying cash flows simply do not support at this moment in time.
Which brings us to the final question I want to leave you with today. The data clearly shows SXT's current valuation is heavily detached from its fundamental cash flows and historical norms. So, can SXT's future growth realistically justify this massive premium, or is a correction inevitable? Keep that in mind as you continue your own research. Thank you so much for joining me for this explainer, and keep learning.